Greetings, Jonathan Camarda, as we head into the dog days of August. Kids going back to school, so if your children, grandchildren go back to school, I'm used to up north in New York after Labor Day, but it happens real quick down here in the South. Speaking of real quick, Fitch joined the Standard & Poor's there on the ratings, dropped us down a notch. Jeff will have a separate video to go into a little bit more detail where he sees that. As far as the reactions last week, again, you had treasuries, the 10-year treasury yield going above 10% again, which creates maybe a little bit of a headwind here for equities in the very near term. Now, as far as the rationale for the Fitch downgrade, again, basically deficits. We have huge deficits running with a lot of the social spending programs in confluence with what's projected to be a 10% drop in revenue this year, and tax revenue and such for the government. So a bad combination there. Maybe you could be asking yourself what took them so long. The effect overall, most don't really project much of an effect on equities, and historically, over any period of time, has not had a huge effect. And it does appear that this will be a one and done, from the way they labeled it. Again, Jeff will expound on that. Now, as we get, again, 10-year treasuries, a little bit of a headwind in the interim. Inflation data. When we start to look at inflation, it is kind of a mixed bag. We've had slowing CPI. Jobs numbers came in at only 187,000 Friday, although wages are what they call sticky, staying resilient. But the 187,000 was below the 200,000 projection. So again, that's generally anti-Fed rising and raising rates there rather. Whereas oil, however, is another story, and the supply-demand dynamics there, again in the Middle East, Saudi Arabia and such, they are cutting supply, perhaps to hedge against the recessionary winds to protect that price per barrel level. And as such, however, again, it is a major component of the CPI. So we do project, based upon oil, $82 a barrel right now, like we've seen, that the Fed in September, November probably will hike again. Now, to that note, Friday, if you were looking at your accounts, you saw the market, rising pretty nicely after some tech earnings, which we'll get to. JP Morgan came out with a little bit of a douser, and whether it was coincidental or what, although very little seems coincidental in the markets, right? So JP Morgan came up with a note saying that the Fed is not even close to done yet. Very interesting. And of course, markets reversed the rally there. It's just kind of an interesting dynamic that occurred. So when we look across the landscape, though, we do see economic slowing, in the sense of intermodal transportation numbers, the supply chains. There is a slowdown, so that dousing effect that the Fed had wanted, even globally, is occurring. So again, it is kind of a shade of gray from that standpoint. So with that being said, as far as earnings, we don't usually get into the granularity of individual names, but I couldn't resist this quarter with what we call the MAG-MAT earnings. The earnings beats have been, of course, your Metas, your Amazons, which we saw coming into last Friday, and your Googles, and then, of course, the losers so far with your Microsofts, Apples, and Teslas. Perhaps NVIDIA will be the tiebreaker there towards the end of the month in the sexy AI kind of tech niche year to date. With that being said, strategy-wise, we remain eternally vigilant. This is usually a soft spot, calendar-wise and seasonality and as such for the markets. However, not always. So again, we have our foot near the brake pedal, but we'll watch for anything that looks more than your typical garden variety pullback and make adjustments if necessary in the more tactical strategies. Again, any questions on your risk appetite or any idiosyncrasies you may have in confluence with how you're invested, certainly talk to your personal wealth advisor. With that being said, stay cool, stay frosty, back to school. See you next time.